So when you hear people talking about real estate, there's a lot of buzzwords out there. There's a shifting market. What does that mean exactly? That's really easy to throw that terminology out there and just be obscure. Now, in reality, I'd like to call like a schedule or history to what the market's doing. In the current present, we're all there for the pandemic, and we know what had happened. Initially, the pandemic had happened, and it was a shifting market. What's going to happen? People kind of froze up, didn't do much. Then there was a flight to quality of home, and the ensuing next 2 years with the low interest rates and the ability to work from home provided an environment in which people wanted to move. It was easier to move. It was easier to move somewhere you never thought you could before and still maintain your work. Now, post-pandemic, after those couple of years, 2020, 2021, the markets decided to shift again. Now, not only did it shift, but in fact, every quarter last year was different. So we went from a really high, bustling climate of real estate sales, pushing prices up with low interest rates and high demand. Now, once it got so hot, it started to cool down. We started to have these red flags. Started to have red flags such as gas prices going up, the awareness of inflation and what it was doing to our economy. The war in Ukraine began. And as we started to have these interest rates ticking up, I'll tell you what, I wasn't prepared for the rate at which they would increase the interest rates. I really thought that they would inch them up and bring them down and inch them up and bring them down like they did coming out of the last recession. But because inflation was the focus, the Fed kind of had the blinders on to these other lag measures, these other consequences that might come about, only concerned with, job growth, unemployment, GDP, things like that, not really being aware of lag measures or unintended consequences. So where we are in this moment is we went from, let's call it a 2-year hot market, and then fourth quarter, all of the variables came about. They had their lag. They affected the market. Inventory did go up for a moment, and prices began to drop nationally. Now, what happened with buyers is, I say, they went from being really aggressive to not even to completely inactive or passive. They weren't even involved or engaged. People really got quiet, and they did the let's wait and see what happens. Now, the problem with that strategy is you don't know what your competitor's doing, but as the other buyer, and you start to pile up as a buyer inventory as well. So buyers for the same property would tend to kind of collect up. And we saw this happen in the last 2 winters were actually kind of cold, I would say, in the real estate market, at least in my area. Things were happening, but they were still happening at a slow pace in 21. In 2022, it was pretty bare. So with that being said, coming in about halfway through January and into February, the interest rate had dropped well enough. Interest rate buy downs were happening that sellers were paying for. Closing costs were getting taken care of, and it was a really good buying market under the radar that realtors were screaming about and acting like cheerleaders on social, letting you guys know, and not everyone got the memo. They still were stuck in that action of wait and waiting to see what happens. So some really good opportunities did pass by. There may be some in the future, let's see. But one of the things that we're seeing right now is that the Fed reacted to that almost immediately and started raising rates. Not at the same rate, but they started raising them up. So the big turn we saw in about a year of time, what they were doing is that they did not need to raise at the same rate or increase at 75 or 100 basis points. They were going down to 25 or 50. So that pain wasn't as much, and markets were pricing it in. But since we started to have such a strong activity with more mortgage applications, a competitive market, they raised the interest rates again. Then we have a major lag measure, such as SV Bank, bringing some attention on a Thursday and Friday, and then the next week, it's the only talk that you're hearing on medias is about what's going to happen with the banking system, whether it be a crisis, whether it be a bailout. This is creating a bank run where people want to take their cash. Now, when people take their cash out of banks, they've got to do something with it. Will they buy real estate? Perhaps. Some of those folks might become the cash buyers that you're competing with, pushing prices up even more. Now, coupled with our thin inventory and interest rates are probably the two ingredients that matter the most. But inflation matters, food prices, gas prices, jobs. Are we keeping our jobs? Those things matter too. The larger economy is the environment that those two variables are swimming in. And with the aim of the Fed wanting to stomp out inflation at any cost, it's hard to stretch out and make a purchase when you know there's pain to come. Buyers might be thinking, am I going to keep my job? Is there going to be a business closure? There's a lot of negative things that come with buzzwords like recession. So I get it that people, are struggling with making this purchase. But at this time in history, prices are likely to be much lower, and the affordability is much likely going to be much lower at this point in history than it's going to be in the next 5 to 7 years. This inflation and all that printed money still has to work its way through the system, and we're likely going to see the dollar get smaller and smaller. Now, we got into this place because the Fed had printed too much money. We got into this place because the government decided to print money during the pandemic. For better or for worse, they did what they did. Now it's created this lag measure where banks might be closing down, but to do bank bailouts, we're going to infuse more money and create more inflation. So when you think about prices long term, it's likely that they're going to be even higher in the future. So whether it's the right time right now or it's the right time in the next year and a half, you definitely want to make an aim to purchase a home. I'll say this, when a buyer has an aim of buying within a year, they're much more likely to purchase that home in 3 months to a year versus longer. If you go a whole year of house hunting and you haven't gotten in the home, that year can easily turn into 18 months or 2 years. And then at that point, when you started the journey, it's really painful to look back at what you could have had. The key to real estate is to get in to a mortgage you can afford, start paying down that amortized interest rate, and move on into wealth building. Hi, this is Jeff Belzer. Thank you for watching Living in Ventura County.